Stocks closing mostly lower, but off the worst levels as the consumer price index for January did come in hotter than expected. Market participants now pushing back expectations for the next rate cut into the second half of the year, and Fed Chair Jerome Powell reiterating on Capitol Hill today that there is still more work to be done on inflation. Well, joining us now is Vincent Reinhart, BNY Investments Chief Economist. Vince, always great to see you. Let's start with that CPI report, Vince. Topped forecast. Obviously surprised a lot of folks. Did it surprise you, Vince?
Last mile in reducing inflation is hard. A lot of the progress we got, a lot of the favorable headlines, particularly last year, were related to energy prices, were related to fast-moving, flexible prices that are below the Fed's goal of 2%. But the slow, inertial stuff, services, the things that are the result of individual decisions in lots of places, not lined up in time, they really move slowly. And that's what's happened. Slow-moving prices are, still increasing on the order of close to 4% last month. In that environment, you're not going to get to 2 quickly. That's what everybody's got to appreciate. Last mile is hard.
And even something that was supposed to be improving, Vince, it's Julie here, good to see you. Shelter inflation, right? Yeah. Which had been trending down, saw a little bit of a resurgence this month, and that's got to be something that maybe concerns the Fed too.
Yeah, that was a surprise. Shelter had, as you noted, monthly changes had been pointed down. My suspicion is that the folks at the Fed will slice and dice the data, compare it to the big data sources where they get real-time information on shelter prices, and probably conclude some of it is just seasonal. It's the beginning of the year. People rewrite contracts at the beginning of the year. Maybe it was a slightly larger change than normal.
Vince, is the Fed done cutting this year?
So that it's a much better question today, right now, than it was at 8:29 this morning. I think that's right. Look, where is the Fed positioned? And if you look at their last forecast, if you look at the statement, they're leaning a little over the board. Their last direction was down. That does suggest that they're at least inclined toward easing. But the case has got to be made, and it's not made now. Fed's real problem, which is why this inflation outcome was actually probably good news for Chair Powell, is that their concerns about inflation wasn't last month's shelters number, wasn't the general slow-moving nature of sticky price inflation. That's all backward looking. And that's pretty much playing out how you might have thought. Our forecast didn't have much progress in reducing inflation and only had the Fed easing just twice this year. Got to trim that back, of course. The problem for the Fed is forward-looking, that if the White House puts in place some of the policies it's discussing, that will add to inflation. But if you're Jay Powell, you can't go on Capitol Hill and say, we're not going to change rates because we're worried that President Trump's policy is going to add to inflation this year. What can he do now? He can look back and say, inflation a little hotter than we thought, good enough reason to wait. They got a better reason to wait. They should wait until they see the results of some of the administration's policies and what that does to inflation.
Vince, quick question, because we were talking to another economist earlier in the show today. I asked him, what are the chances, what are the probabilities that actually the Fed raises rates this year? He put it at 25%, Vince. I'm curious, you agree with that call?
Too high. And that's because the Fed's got some margin between where it is now in its overall position of policy and to the point where it cuts rates, raises rates, sorry. Its guidance is still saying that it will cut rates. So the first line of defense will be to revise the guidance up. That's the equivalent of tightening policy. Second line of defense, try to shape longer term expectations. That is, what they start talking about the equilibrium or long-term policy rate. That starts moving up, then the longer end of the yield curve will reflect the sense that Fed policy will be tighter for a long time to come. If you can convince markets that rates are going to be tighter for a long time in the future, you don't actually have to move right now. And, it's not exactly a vote of confidence, or at least Fed officials would probably think that, to have embarked on a big easing with a 50 basis point cut just in September and then turn around and start raising rates.
Right.
So they'll put it off if they can.
Well, for what it's worth, the same economist we spoke to earlier said that 50 basis point maybe wasn't the best idea, but...
Yeah. History always reads better after the fact, right?
Fair enough. Vince, I want to ask you one final question. You mentioned the potential effect of tariffs if they do stick around. I want to ask you the potential effect of something else that the government is doing. And I'm going to read a tweet from Elon Musk, or a post on X from Elon Musk earlier today. He said, as it becomes clear that Doge is working, you will see the long-term Treasury bill yields fall, and all Americans will benefit from lower interest payments on mortgages, small business debt, credit card, and other loans. Do you agree with that assessment? Is that how you see that playing out?
I believe in the mechanism that if Washington, D.C. were to credibly signal that the budget deficit is lower now and is on a trend that not to deteriorate, that the Treasury would be rewarded in markets, yields would go down. However, my concern for Elon Musk is the budget deficit didn't get there because of decisions on by a lot of independent federal agencies staffed by remote bureaucrats. Congress is the co-conspirator. Congress authorized spending, Congress authorized tax cuts, and that Congress is going to start pushing back, as your interview earlier with Senator Warren might suggest, that the agencies they created should be able to spend what they authorized. So, yes, mechanism is right. Make progress on the deficit. Reverse the trend of deficit deterioration, at least, and you'll get rewarded in capital markets. However, capital markets are going to wait for something durable. And durable is to get the government of the United States to agree to a more sane fiscal trajectory. That's not done by tweaking payment flows.
Vince, it is always great to see you and have you on the show. Thanks for joining us, sir.
Thanks for having me.